Okay, let's just dive right into this. Imagine a multi-millionaire investor, someone with 40 years of market experience who suddenly loses absolutely everything. I mean, no assets, zero secret bank accounts, just a phone, a low salary, and a totally clean slate. What exactly would they do to rebuild their wealth from scratch in today's world? Well, welcome to this explainer, where we're going to unpack a step-by-step blueprint from a seasoned investor who asked themselves that exact question. We're going to break down the precise strategy to go from absolute zero to a confident, growing portfolio. Look, the investing world is loud, right? There's endless noise out there, a million different apps, and just constant hype. Honestly, it causes massive decision fatigue, and frankly, it paralyzes a lot of absolute beginners before they even pull the trigger. So this explainer is designed to be a complete hand-holding journey. We're cutting straight through the noise and looking at a proven, simple system to totally eliminate that fatigue.
So here is our roadmap. Step 1, setting up your foundation. Step 2, the tax-free advantage. Step 3, the 3-fund portfolio. Step 4, executing your first trade. And finally, knowing exactly when to sell. Let's get right to work.
Section 1. Setting up your foundation.
You know, the very first hurdle beginners face is this paralyzing fear of just choosing the wrong platform. But honestly, a reliable platform checklist is actually really simple. First, and absolutely foremost, is FCS protection. If a platform doesn't have this, you literally need to run the other way. This basically means that if the platform itself goes belly up, your money is legally protected up to £120,000. I mean, that is ultimate peace of mind right there. Next, you definitely want low fees, because those small little charges will just eat away at your compounding growth over time. You also need a solid range of stocks and ETFs, the correct account types, and of course, an interface that isn't a nightmare to use. Now, based on the source analysis, the platform that ticks all these boxes for a beginner starting today is Trading 212, though others certainly work if they meet these exact criteria.
To actually get the account open, you just need to gather 4 quick things. It's really fast admin work, so let's keep the momentum moving here. You'll need a valid photo ID, so think passport or driver's license. You need your national insurance number, which you can easily grab from an old payslip. You need a proof of address, like a basic utility bill. And finally, just be ready to take a quick selfie to verify it's really you. It literally takes just minutes.
Section 2, the tax-free advantage.
Okay, listen up on this part, because making the wrong choice of account type could quite literally cost you thousands of pounds in completely unnecessary taxes down the line. If you just go and open a standard invest account, you're going to be hit with capital gains tax. This is a tax of generally 10 to 20% on the profits you make. Imagine grounding and growing your wealth over decades, only to hand a fifth of your hard-earned profits right back to the government. No thanks. Also, let's just quickly dismiss CFD accounts while we're at it. Those are for day trading, and statistics actually show that 80 to 90% of day traders lose money. It's incredibly high maintenance and just not for beginners trying to build long-term wealth.
So the crucial point for us is this choice right here, the stocks and shares ISA versus the cash ISA. And let's just bust a massive myth right now. A lot of beginners think the 20,000 pound ISA limit means your actual account balance can never exceed 20 grand. That is entirely false. The limit is strictly on your yearly contributions. So you can put in up to 20,000 pounds a single year. And if that money compounds and grows into a £1 million portfolio over the decades, every single penny of that profit is completely tax-free. Our source heavily champions the stocks and shares ISA over the cash ISA, because while cash ISAs are definitely low risk, their interest rates are historically way lower than the long-term growth of the stock market. So for true wealth building, the stocks and shares ISA is just the undeniable winner.
Section 3. The 3-fund portfolio.
Now, if you are stressing out about picking the next big winning stock, just take a breath. We're introducing the Bogle Hedge strategy. Named after Vanguard founder John Bogle, this is a beautifully boring but incredibly effective method to just grow your wealth steadily, survive nasty recessions, and stay invested for decades with zero stress. To really wrap your head around this, think of an index fund like a massive basket of companies. Instead of buying Apple and just praying it does well, you buy the basket, and boom, you instantly own a tiny piece of hundreds of companies. Now you specifically want to look for an accumulation fund. This is the magic keyword here. It means any dividends, those little profit-sharing payouts that companies give you, are automatically reinvested right back into the fund to buy even more shares. It requires zero manual effort from you. It's basically the ultimate set-it-and-forget-it wealth machine.
So what actually goes into a 3-fund portfolio? Well, it's pretty much exactly what it sounds like. First up, U.S. stocks, like an S&P 500 fund, which gives you a piece of the 500 biggest companies in America. Second, international stocks, just to capture some of that growth outside the US. And third, bonds. Think of bonds as essentially you lending your money to a government, and they pay you back with a little interest over time. They are very, very stable. For a middle-aged investor looking to kind of protect their wealth while still growing it, a split like 45% US stocks, 30% international, and 25% bonds creates this wonderfully balanced safety net.
But hey, what if you're a bit younger? Well, you have something incredibly valuable on your side: time. You can absolutely afford to take more calculated risks because, think about it, if the market crashes, you literally have decades to wait for it to recover. And historically, it always has, often bouncing back even stronger. So, a younger person might shift that allocation to, say, 55% US stocks, 35% international, and shrink those conservative bonds way down to just 10%. It's all about perfectly matching your portfolio to your own personal timeline.
Section 4. Executing your first trade. All right, so once your foundation and those boring index funds are completely set up, maybe you want to dabble and buy individual companies like Tesla or Amazon. Now, what's absolutely amazing about investing today is that you don't need hundreds or thousands of dollars to buy a single share of a huge tech giant anymore. Enter the fractional share. This concept is a total game changer. It completely removes the financial barrier to entry, meaning you can just own a tiny slice of a company. You can put in as little as £100, or frankly even less, and you instantly become a part owner of these massive global companies.
Now, when you actually go to hit that buy button, you're going to see a bunch of confusing jargon pop up, things like limit orders and stop limits. Let's just demystify that right now so you aren't guessing. A limit order lets you set a strict maximum price you're willing to pay, but the catch is the trade might not execute right away. A market order, on the other hand, just says, hey, buy this instantly at whatever the current market price is right this second. For a beginner who's investing for the next 20 years, our source highly advises just keeping it ridiculously simple: use market orders. Trust me, tiny price discrepancies of a few pennies today will not matter one single bit 2 decades from now.
And honestly, why are we doing all of this? Just take a look at this number: £525,000. Our source provided this totally fascinating projection. If you were to invest just £500 a month into this steady, boring, 3-fund portfolio strategy we talked about, thanks to the sheer magic of compounding interest over historical averages, it could be worth over £500,000 in just 20 years. And your actual out-of-pocket investment would be just a tiny fraction of that total. I mean, that is the empowering, real-world reality of consistent, automated investing.
Section 5. Knowing exactly when to sell.
You know, most beginners totally obsess over when to buy, but here's the truth. Holding onto a stock for the wrong reasons can destroy your wealth just as fast as buying a bad one in the first place. Our millionaire source actually outlines 3 master rules for pressing the sell button. You sell when momentum is dying, when you are actively funding a bigger opportunity, or when the market fundamentals permanently shift against you. Let's do a really quick deep dive into each of these so you can protect your gains.
Reason number 1, momentum is dying. We really have to warn you against this toxic diamond hands internet culture. Sometimes a stock skyrockets purely based on social media hype or some influencer's momentum. The source uses Lemonade Inc. as a prime example of this. It got totally pumped up, but the actual underlying business was struggling hard. When you realize a stock is soaring just on hot air and hype, it is incredibly smart to sell a portion, say 30 to 40%, to lock in those profits before reality sets in and the inevitable crash actually happens.
Reason number 2, a bigger opportunity arises. Listen, it is perfectly logical to sell your stocks if you genuinely need the capital to fund a superior life move. Maybe you found an absolute steal of a real estate deal, or you need capital to launch a business that you directly control. It makes zero sense to risk leaving that money in the volatile stock market right before you need it to close on a house. Reallocating your capital to build wealth in other avenues is a total power move.
And reason number 3, the market shifted. Holding onto a stock out of sheer loyalty to a brand is just dangerous. Our source brings up some brilliant examples here. Just look at Warren Buffett dumping his airline stocks during the pandemic because he realized the entire travel landscape had fundamentally changed. Or look at how traditional print media stocks totally died when the smartphone era took over. If a business model becomes obsolete or the management suddenly proves untrustworthy, you logically cut your ties. Smart investors just don't get sentimental.
Which brings this entire explainer home to the ultimate golden rule of investing. Time in the market beats timing the market. Guys, compounding interest does not care about your emotions, it doesn't care about your daily motivation, or what you think the market might do next month. It only responds to consistency.
The real winners in the investing world aren't usually the hotshot, stressed-out day traders. They're the calm, boring investors who just consistently buy and hold through all the ups and downs.
So you've seen the platform checklist. You clearly understand the massive tax advantage of an ISA. You know exactly how to build a stress-free three-fund portfolio, and you now have the psychological rules for exactly when to sell. You literally have the blueprint. Timing the market beats timing the market. The only real question left is, are you ready to start the clock?